So this has been a very weird year. We are in a very balanced market. It might not feel like it, but we absolutely are. And it is beginning to trend towards a buyer's market. I don't think we're going to hit a buyer's market this year, but I do think we're on our way there. And we will probably be in one next year if this trend continues. Before I get into the data, SNLR is the sales to new listing ratio. It's when you divide the number of sales by the number of new listings. The Bank of Canada defines a balanced market as anything between a 40 and 60% SNLR. It defines a buyer's market as anything under 40% and a seller's as anything north of 60%. Okay, so 5 months through the year, we are sitting at a 50.21% sales to new listing ratio. That is worse than 2019. That is the worst SNLR for 5 months through the year since 2018. May alone was worse than what we had in 2017 and just a hair better than what we had in 2018. The market right now is very balanced. It is slightly favoring the buyers at this point, and it is trending towards a buyer's market. I don't think we're going to hit that this year. Real estate cycles don't just happen like a flash in the pan. They take time to develop. And I do think heading into 2025, given all the macroeconomic trends in Canada, that we'll probably hit that buyer's market at some point in 2025. Now, what do you expect in a buyer's market? Of course, the accumulation of inventory, right, will eventually cause downward pressure on prices. Now, how much? Probably not that much. If we're going to talk in real or nominal terms, that is very important. Are you considering inflation on this whole thing? If so, well, it's probably going to be more dramatic. But if you do factor in inflation, there's a good chance that a price drop is not going to be as significant as a lot of the real estate bears would have you believe. Now, with that being said, I don't see the real estate bull case in Moncton. Real estate works best when you hold it for a long period of time. It's not like a stock. It's not something you buy and you hope to sell in like a year or two. It's like cooking a turkey. You put it in the oven, you forget about it. You don't worry about it until the timer goes off. Okay, so typically in real estate, most people own 5 to 7 years, and that's a healthy period of time. If you're planning to own property for less than 5 years, you should really reconsider your decision. There's a lot that is involved in trading real estate, and it's not always a liquid asset. So when you buy, you're going to have your transfer tax, lawyer fees, and then when you sell, you're going to have your commission and then your lawyer fees. And of course, the whole time you're going to be paying property taxes, repairs, maintenance, that sort of thing. Really, if you're only going to be living in a place for, 2-3 years, you should probably consider taking your down payment and investing it elsewhere. There's a thing called opportunity costs that people often don't realize when they're investing in real estate, especially when they are buying in a place that they've never lived in before. Looking at these active listings, we finished May with the most active listings we've had since 2020. And of course, our sales have not been keeping pace with 2020 sales. This means that inventory is beginning to accumulate. Now, what we're not seeing, though, is the price drops yet. This is the very early stage of supply being introduced to the market. There's a lot of listings out there that I'm surprised have not sold, and then, of course, there are listings that look like they should have sold, and they didn't. It's a very confusing time to be in real estate, and even I have not seen this. Okay, I'm going in my 9th year. I've never worked in a market that was shifting down. I got licensed in early 2015, and that market, even in 2015, we saw some momentum going in the right direction in 2016. This is a totally different ball game, and it's very confusing. It's very hard to price a house right now because on one hand, you look at the sales data and the active listings, and the data will support a certain price. But then someone's house 3 doors down will sell much higher than what the data would support. So there's really a couple options that you can do as a seller in this market. And I really don't know what I would recommend. You could price it low and aggressively and hope to catch some momentum, get some multiple offers. That's probably the most tried and tested method to succeed in this sort of downward shifting market. And then number 2 is to price it a little bit higher, knowing that you're probably not going to get many showings or offers, and when you do, they might be a little bit lower than the asking price. And there's a risk reward to both scenarios, because if you price it low and you don't get the offers or the momentum that you need, it's going to be really hard for you to sell that thing at asking price if it's been sitting for more than a month. And it's a really, really hard time, and I really do feel bad for people that do have to sell right now. It's a very confusing and tricky time. If you're currently listed right now with a realtor and you're wondering why your house is not selling, it's not your realtor. In fact, usually it's not your realtor if your house isn't selling. As long as the photos are good, the advertisement's okay, there's really not much of a difference from one agent to another. Back when the market was really slow, we had this saying, or at least I was told this saying by someone who had been doing this a long time. You always want to be the firstborn, the second wife, and the third realtor. And that wasn't because the third realtor was the best one. It's because by the time you got to the third agent, you could usually get a lower price on the listing. The sellers were more patient and they were ready to kind of ride it out through the process. Oftentimes it can be difficult being the first agent to a listing because the expectations are very high. It's a very weird time, okay? So if you're listing right now and you're wondering why your house isn't sold and your neighbors did, give it time. Our house is still going over asking. The answer to that question, even since 2015, has been sometimes. Sometimes I do, sometimes I don't, sometimes they go under. So what I did here is I pulled up some data. This is the average close price to original price ratio. So this is not factoring in price drops. This is what people originally listed the house at and what they eventually did sell it for. So in 2014, which was a little bit before my time, that was 93.9%. 2015, it was 93.6, 2016, 93.6, and then 2017, 93.9. You can pause and you can look at that there. And then you can see it warm up a little bit in 18, 19, and 20. And even in 21 and 22, you'll see that 100%. Now, if you break that down by the month, you're going to notice that certain months in those 2 years, 21 and 22, were a lot hotter than the other months. That's because 2021 really only started to heat up a lot midway through the year towards the end of the year. We bloomed very late in Moncton. And 2022 was almost the inverse of that. Property values in, January, not even January, February and March, and then part of April were absolutely insane. And by the time May rolled around, it's like everything fell off a cliff. A lot of people were buying on expiring pre-approvals and they had to close by a certain time. And by the time, May and June rolled around, it was a totally different market. It was still a seller's market, but man, was it a lot cooler in that part of 2022 than it was in early 2022. This is the multifamily market. So I don't sell a lot of multifamily properties, but I can analyze a multifamily property as well as anyone. And part of the reason I'm not selling many of them, and I do have investors, is because when I do my spreadsheets and I run the numbers, they don't check out. And I did not understand how those properties were selling in 2021 and 2022. It didn't make sense to me. So as you can see here, the sales to new listing ratio is all over the place, but right now it is below 50%. It was low last year, and it's looking like it's going to finish a little bit below that this year. Now, I'm going to explain something about cap rates. If you're familiar with investing, you know what a cap rate is. If you're not, a cap rate is basically just the rate in which you are going to make your money back. A lot of people, when they do these analysis, they don't factor in the expenses. And one of the biggest expenses when you're running a rental property, especially in New Brunswick, is property taxes. What is a good cap rate? So in 2015, 2016, and even part of 2017 and 18, you could get cap rates in the double-digit range. You could get them at 10, 11. I saw one at 12% one time. It was very common where you could get a double-digit one, and I don't know if I ever saw one go below an 8% cap rate until 2020 hit. Part of that is because as we got more investment from other provinces, people started to apply their investment principles to New Brunswick, and that is a deeply flawed premise. A place like Toronto, where you actually have good ROI on an annual basis, you can float a 3, 4, 5% cap rate, even a 6% cap rate. But if you're in a place like Moncton, well, you're not going to get the same ROI. Your cap rate needs to be higher to justify that. You really don't want to be buying properties based off investment principles that don't apply in the place that you're buying. People will often choose to invest in New Brunswick because it's landlord-friendly legislation. Do not invest in anything if the value of that investment is dependent on current legislation existing. Legislation can change. Governments can change. New elections happen all the time. Should it be a bonus when you're investing? Sure. Should it be the reason you're investing? No. And should it even be factored into your calculations when you're trying to evaluate investment property? Absolutely not. What's going to happen for the rest of the year? It's tough to tell because it's going to depend a little bit on inflation. Of course, the more inflation we get, the higher the prices are going to be, of course, because the dollar is going to be devalued and the properties will go up technically, but in real terms they won't. So I think right now where we're sitting at an average sale price of around, I think we're $357,000 last month. I don't think that keeps up. Our high was April of 2022, and I think it was like 361. I don't think we're going to hit that. I think things will probably come right back down to 330, if not lower, by the end of the year. And certain parts of the market are a lot more inflated than others and are probably due for a lot more of a serious correction than others. Be careful out there. Look at sales data. Look at sales data. Don't be afraid to negotiate. Don't be afraid to lowball. Don't assume you have to go 50K over asking just because you're in multiple offers. Don't be afraid to miss out on a house because a lot more inventory is coming up basically every day. Be careful with your investments. Get inspections too. And another controversial piece of advice is don't pay attention too much to the list price. You'll often run into properties that are going to be a great deal at 50K over asking, and then properties that are going to be a terrible deal, 50K under asking. It's almost counterintuitive to what I've been saying, but don't be afraid to go over asking on the right house as long as the data supports it. And that's the key. The data should support every single real estate decision you make, whether you're investing in multifamilies, whether you're buying a single family house. One last thing I will say, be careful about property taxes. Property taxes are super high right now. If you're buying a property, there's a good chance that the taxes you're going to get are not going to be anywhere close to the same as what the current owner was paying when they bought it. That goes especially true if you're buying an investment property or anything that's going to be tenant or non-owner occupied. Be really careful with these things, and also be really careful when you hear the words proposed rents or estimated rents. There's absolutely no regulation and no data that supports these things. I run through some of these multifamily spreadsheets and they say estimated rents. There is no way, there's absolutely no way that some of these estimated rents are even close to the market rents. You can get an appraisal to get your market rents.